Ladies and gentlemen, welcome back to the Schaeffer's Market Mashup. It's your host, Patrick Martin, and I am thrilled to be back doing episodes with Cboe Global Markets. Today we've got a special episode with two outstanding guests, one of which you might remember, Henry Schwartz, Senior Director, Head of Product Intelligence at Cboe. Henry, how are you?
I'm great, Patrick. Thank you for having me.
And we got the new guy, Robert Hocking, Senior Vice President, Head of Multi-Asset Solutions and Derivative Strategy. Robert, how's it going?
Wonderful. Thanks for having me. Excited to be here.
Yeah, I'm pumped for this. We've been talking about doing an episode like this for a while, and I'm glad it's finally coming together. We wanted to talk about common mistakes options traders make. Both of you guys are, you got your start on the trading side of the aisle. Rob, I believe you did index trading at Goldman Sachs, and Henry, you started in the finance industry as a trader at Hull Group before joining Salomon Brothers as an index trader. Think of Henry and Rob here as, grizzled vets that a team will bring in to, show the rookies how it's done. So it's rookie camp, if you will. And I'd like to start, let's just hop in the DeLorean here for a second. Go back to your younger trading self. You only have 5 minutes to talk to him because of the space-time continuum and whatever. What is one thing you would tell your younger self when starting out trading options? Rob, you can go first, and then Henry.
Awesome. Yeah, I like it. All right, I'll hit the flux capacitor and run our way. I think the one piece of advice I'd offer is to just be patient with the learning curve and really immerse yourself in as much educational materials as you can find. When I first entered the world of option trading, it was intimidating. Unlike stocks that either went up or down, you now had to learn, a whole new language of option Greeks, things like gamma, theta, vega, and how each of them impacted your position. And it takes time to acclimate to these new inputs and concepts. And I found that learning even went in phases. The first phase taught you the basics of how to communicate. The second phase, you could start to anticipate how a position would move, given moves in the underlying. And then the third phase, you could begin to actively position yourself and to take advantage of these anticipated moves, which would lead to the last phase in phase 4, where you could, start to design specific strategies around your desired outcomes. But the process takes time. It's something you can't really rush, and you have to be patient with, because, rushing can really lead to, undesired outcomes.
Mm-hmm. Henry, what do you got?
I think it's a great question. And, I think of kind of all of the kind of trials and tribulations of my career in the business, finding a good mentor and kind of, really working hard to surround yourself with people and resources to learn, I think is one of the most important things. And it's tough. It's as tough as anything else, finding people, asking a lot of questions, working things out by hand, making spreadsheets to double check these concepts, and just, I guess, not taking anything for granted. The deeper, this is something that, that you like and that you're really trying to figure out, you can just take it apart and ask questions and being with people that know what they're doing and have some perspective, I think, is crucial. So that's my tip to myself.
I like that a lot. Well, power ranking is everything these days on the internet, for better or for worse. It's clicky, it's grabby. So I want to take a stab at that here. Same order. Rob, you can go first. Power rank the top 5 mistakes options traders tend to make.
Sure. Yeah, I love the question, and I'm definitely guilty of many of these when I started in the business. But top 5 mistakes, let's see, I would probably start with not having a clear entry and exit point for your trade. And I would really stress the exit point part. I think it's easy to track different stocks, find ones you like or companies, that you associate with. But then, you have to take that general interest and turn it into clear metrics of where you will, get into a trade, and then where, you'll get out. And that applies to setting criteria, around both winners and losers, because let's face it, not all trades are winners, even though we like to think they are. And that really leads right into, I guess, my number 2 mistake, which would be, don't let emotions drive your trading decisions. To be successful, it's helpful to remove all emotion. When emotion is involved, it becomes easy to take your winners off too soon and ride your losers longer than you should. And by setting these clear entry and exit points, as I mentioned, and removing that emotional component from your trading, it helps eliminate, second guessing your decisions in the heat of the moment. And ultimately, playing Monday morning quarterback with your trading decisions tends to always be a losing proposition. Mm-hmm. Let's see. Third, I would point to is not fully understanding the liquidity of the product, you're trading before entering the trade. For some products, it can be easier to put on a position than to take it off. But, by understanding the liquidity constraints of each product you trade, I think it helps you be more realistic about, setting those entry and exit points. And then really the associated performance that you can expect and be realistic about, what's possible. Let's see. Fourth, I would say, misunderstanding leverage. Options provide a source of leverage because, of their 100 multiplier and can appear, at times quite a bit cheaper to purchase when in comparison to an actual stock. But, this can lead investors to having larger notional option positions than they otherwise would have thought. And if they're unfamiliar with this component, sometimes it can lead you to make poor decisions and some, unanticipated consequences. And then lastly, I would say number 5 is not understanding the impact of corporate actions and what, their impact on option positions. In many situations, options have to be adjusted due to stock splits, mergers or acquisitions, special dividends or reverse splits. And, for example, when a cash dividend's paid out, it typically, doesn't have an effect on the option. But when a stock split occurs, it can affect the strike price of the option. So to understand when and how these different events impact your positions becomes extremely important.
Great. That's an outstanding list. Henry, what about you?
Well, we should have done this David Letterman style. It should have been like, working our way up, and then there'd be a drum roll for the biggest mistake. That
I can add some sound effects into this as okay, in post-production.
That's fine. All right, so I have also made a lot of mistakes, and that's kind of part of learning anything. But I think that there's a few tenets that veteran traders like us have accumulated over the years, and honestly, it's the kind of stuff that like guys on the floor would yell out, and you'd be like, that's kind of catchy, and it sticks in your brain. I'll give you my top 5. I think the biggest mistake I see people make, and I've made even myself, is sizing of positions and trades. You have an account, and you want to be, maybe not scientific, but you definitely want to be consistent about how you set up your trades and how much money are you going to risk and how big are you going to be. You can't wing it and just say, I'll buy, whatever, 1,000 of these shares. Is it a $12 share or is it a $50 share? Mm-hmm. Makes a big difference. So position sizing is my number 1. Number 2 would be not being patient. Rob mentioned this at the beginning. Not waiting for the opportunity that you kind of think is coming along because you're impatient. You sit down in the morning, you have your coffee, you start watching the markets, and you want to trade something. That's not quite the same as really actually finding everything that meets your criteria and then kind of methodically executing a plan. So trading before it's time, according to your own belief, is number 2. Number 3, illiquid options. They definitely can be a problem. The way that the market has evolved over the last couple of years, it's a very liquid marketplace in most cases. But you have to understand when liquidity is good and when it might not be good, and you can have a very different outcome on a trade, or you can get, as Rob mentioned, you can get stuck in something that was reasonably tight when you entered it, and now all of a sudden you're like, for me to get out of this thing, it's going to be some 30-cent bid offer, and what's plan B? Or can you manage the trade? Can you possibly offset the trade in a different way? Number 4, covering shorts. This one is something that I'm sure you heard in the pits, Rob, which is when to buy back your short options. On the floor, it would be don't be a dick for a tick, which means, you know what, if some option that you're short is down to 2 or 3 cents, you should be covering it. There's just no reason to leave the risk on, even if the thing expires tomorrow. And what's actually kind of nice is a lot of the brokerage platforms now for retail don't charge commissions at all for options that are under a quarter. Makes that a little bit easier. It's just being disciplined. And number 5, I selected legging into spreads, which is tricky, right? You know, you see something line up on the screen, you're like, okay, if I can buy these, this 8 lot, and then I just need to sell this other 8 lot, at maybe a tick better than bid, and you buy one side, and then you put your offer out on the other side, and you never get filled, or you look away for a little while, and the market moves. Legging into spreads is tricky, right? You have a whole negative selection problem there. So, complex order books that these exchanges operate now are really good, can handle almost any kind of spread anybody can think of. And I think it makes a lot more sense than trying to leg into something. And if you're going to leg things, you better understand the risk that you're taking.
Okay, very good stuff. I want to unpack that a little bit here. Henry, you mentioned position sizing as the number 1 mistake. Last 2 years, there's been a ton of referencing examples for anything and everything. The market volatility of 2020, the pandemic, the meme stock trading of 2021. Can you think of a particular moment when having position sizing would have been prudent advice, the last 2 years?
Well, yeah. I mean, the last, just in the last 6 months, we've seen, some kind of crazy behavior of some of these meme stocks, it's things moving faster and further than most people would expect. And that's exactly where sizing comes into play, right? You can put on a trade and say, look, there is no way this stock is going to double by Friday. Most of the time it probably won't. But there is that 1 in a million or 1 in 1,000 chance. And, position sizing is just an intelligent way to not blow yourself up. Doesn't matter how much you love a trade. Weird things happen. So if you're being, properly disciplined and, you get some element of diversification by keeping your trades, reasonably small, it protects you. So, this year has been a great example. And, the GameStop and AMC, some of these stocks have done some really weird moves, very surprising, things that are effectively impossible in your typical probability analysis. And position sizing is what covers your butt on those cases. Yeah,
very good point. Same question for you, Rob. With an exit strategy, what can you provide any context that you might have seen with that one mistake in the last 2 years?
Yeah, of course, and I think it ties really nicely to Henry's position sizing and just what we both kind of mentioned, which is have that plan going in, understand what you expect and what you want, and have that plan going in, because as I mentioned, picking entry and exit points and really removing emotion from your trading decisions. It's extremely important. And as Henry started to point out, especially true if you look at the recent events that have taken place in the last 18 months. Back in March of 2020, when we saw the vol spike and the subsequent market sell-off because of the pandemic, or in the recent trends in the meme stock, trading, moves are happening faster than ever. And if you don't set those clear boundaries around your trading decisions, you could end up chasing positions or, even worse, have your BD close out your position for you, which nobody ever wants. But if you go into the trade and you look at the underlying volatility of the stock, you acclimate yourself to the anticipated moves you could see, and then set clear points to enter and exit. You limit yourself to those defined outcomes, and you're rarely, if ever, caught in a situation where that outcome is unanticipated. And you remove what I like to call, and I've seen so many times, is that mindset of, just one more tick and it'll come back, or one more tick and it'll come back, one more tick it'll come back, and then before you know it, it's it's, 24 ticks away and you've just lost another X amount of dollars than you had intended initially. And so, especially around the meme stocks, especially with the recent volatility that we've seen in the market, I think it's more important than ever right now to follow that.
Mm-hmm. Very well said. Let's take a step back. And Henry, you can go first. What trends have you seen in terms of these new retail traders that are flooding the market and their participation in the markets in the last year?
Well, it's been an amazing year in terms of overall volume. So, kind of the very first thing that jumps out at anybody that looks at this market is holy cow, we're looking at 35 to 40 million contracts a day in volume, which is basically double what we were looking at a couple of years ago. A lot of this is in the form of these tiny trades coming from the retail segment. And so I've tried to look at the data a whole bunch of different ways. The simplest to me is just look at the smallest possible trades, the single contract trades. And there's been a big concentration of this growth in single stocks, even more than ETFs and indexes, which are both up as well. But the retail segment that is coming and seeing this incredible growth from this combination of kind of the work from home period, which has lasted a pretty long time, and the this emergence of these zero cost brokerage platforms. That combination has created an enormous amount of volume. We see about 3 or 4 million contracts a day in single contract trades that just weren't there 2 years ago. They just are brand new. Now, some of this is probably coming from institutional or professional traders and hedge funds that may be algorithmically slicing their orders up to kind of blend in with the retail flow. But small trades, and a wider dispersion of symbols that they're active in. So we have about 4,500 underlyings with options today. And currently about 40% of those have average daily volume below 200 contracts. So those are the very liquid names. It sounds like a lot, but 2 years ago it was about 60% of the listings had average daily volume below 200. So so in like another example is just the amount of the market, the options market that's the SPY ETF activity is about 10% in the last quarter on a daily basis, and 2 years ago it was about 17%. So this retail base has really embraced options, and it's a really interesting shift. It's probably the biggest paradigm shift in terms of the way the options markets work that I've seen in probably since we kind of truly began to automate trading in around 2000.
Yeah, I'm inclined to agree. Rob, you got anything else to add?
Yeah, I would just say, it's an extremely exciting time for an exchange and actually product development around this new market segment as well. And as Henry, pointed out, the numbers are off the charts. I think, that begs the question, and we get the question all the time at the exchange, will it continue, or do you think it will continue? Mm-hmm. And I think the answer is yes. And I think it's thanks to the increased access points, such as smartphones, tablets, online trading platforms. Information and the ability to trade is at, pretty much at everyone's fingertips now. And I think this new investor class is here to stay because of it. And if anything, will continue to grow. Having direct control over your own financial growth can be really empowering. And because of that, I think it'll continue to drive adoption.
Yeah. And something that was alluded to, and this will kind of pivot into our, the final question here, is the ease of access options traders have now. That's great. That's outstanding. And I think both of you are correct. I'm with you there that this is something here to stay. It's definitely a paradigm shift. With that, though, I think there is seeming like an oversaturation of information out there. And especially starting out, I think it could be daunting to try to parse out what's good information, what's not, who to trust and who not to. With that in mind, if you're an options trader starting out, what are some resources that are deemed irreplaceable, I guess. Rob, you can go, and then Henry for closing.
Yeah, thanks for that question, Patrick. I think, education is an essential component and something Cboe is heavily invested in. Off the top of my head, from a resource perspective, I think back to my early days in trading. When I entered the business, what was considered kind of the options Bible at the time was Sheldon Natenberg's book. It was Option Volatility and Pricing. And then the other one that was big at the time was Lawrence McMillan's book, Options as a Strategic Investment. Now, with that, I'll give the caveat that when I got into the business, the internet was not what it was today. And there were a lot fewer resources out there, but I found those books helpful, and it's what a lot of the trading firms would issue to help people really get acclimated to the market. Now, in addition to that, and I'd be remiss if I didn't mention, Cboe's Options Institute is an incredible resource and has a variety of offerings that can assist users really at all levels of sophistication, on their options education journey, so to speak. We offer educational webinars that you can find and register for, through our events calendar on the Cboe Education website. We have things like our custom options trading tools, which include, options calculator, and something near and dear to Henry's heart. We have previews of our Cboe's trade alert functionality to let you know what's going on in the market. You can subscribe for a free trial to Cboe's Live Vol, which is our premier trading, analysis tool. Or you can subscribe to, monthly Inside Volatility newsletter and catch up on recent trends. And then we also offer bespoke programming and private tutoring suited, for small groups or companies. And so you can see, in the market where there, to me, I actually think there's limited resources, but a lot of noise around the limited resources that are there for options education. We've made it our mission to educate and arm people with that knowledge needed to really create, lifelong investors. It's incredibly important to us.
Very well said. Henry?
Well, I agree. The education, it's funny, I've traded, I've built software, now I'm part of Cboe Global Markets, and that's a lot of spheres of the business. Education has always been, I think a weak spot, in finance in general. The internet certainly opened a lot of things up. I think that, there's more, the resources that are available for a retail trader or somebody learning the business have never, ever been better. Rob knows the tools that are available to, for free to a retail account are better than what we started with, a decade or two ago. Just in terms of visualizing volatility, seeing quotes change, the alerting that we provide, I will certainly brag about, helps people see what's going on. I think there's some amazing lectures on YouTube. If you look up some of the academics, there's a lot of free stuff out there. You do have to kind of make sure things pass the smell test. Mm-hmm. Don't fall for, some of the get rich quick scams that are out there, because they are out there. But I think approaching it realistically and intelligently to learn how to use these, derivatives as tools that they are. Some of the panels I've listened to, somebody say, an option is a tool, just like a chainsaw is a tool. So if you know how to use it, it's great, save you a lot of time, very powerful. If you don't know how to use it, you'll be in the hospital. So, I would say that, starting with the best base that you can get in terms of creating an understanding of what you're working with and being careful about it and not falling for some of the pitfalls that are out there is the way to go.
So what you're saying is, if you listen to this episode, you won't end up in the hospital. We can put that in writing.
I hope not.
Yeah. And I guess on my end, I'd be remiss if I did not shout out Schaeffer's own educational articles on our website. We update it weekly with everything from breaking down different hedging strategies, using our expectational analysis. We're even putting together the master list of meme jargon, since some of that can be hieroglyphics to people. But I think both of you touched on salient points there about the integrity of the information, and having a plan is just so important. And hopefully, you guys continue to put out content like that. It helps people along the way. I'm good with wrapping there, guys. I think that was pretty darn illuminating and informative. Thanks again, Henry and Rob. I'd love to have you guys back on in the future to dive deeper into some of this. Honestly, I feel like we can go on for hours, but thanks again, guys. I really appreciate it.
Yeah, thanks for having us. Appreciate it.
Cheers, everybody.